All right, welcome to day 10 of our Crypto Trader Explainer. Today, we're opening up the hood of your trading portfolio to decode what is probably one of the most famous, but honestly, most widely misunderstood tools in technical analysis. I'm talking about the Relative Strength Index, or the RSI. We're going to strip away all the confusion today and see exactly how the pros read the market's hidden pulse. So here's our roadmap for today. We'll start by defining what the RSI actually is. Then we'll dive into overbought versus oversold conditions and look at how to spot market divergence. After that, we'll cover the limitations of the tool, analyze it in a trend context, and then we'll wrap things up with a practical step for historically backtesting these signals on your own. Okay, Section 1. What is the RSI? Basically, the Relative Strength Index is a momentum indicator. It's measuring the speed and the change of price movements for any given asset. Now, think of it kind of like your car's engine temperature gauge. When you're flying down the highway, the speedometer tells you exactly how fast you're going, right? That's the price of Bitcoin or Ethereum printing on your chart. But the temperature gauge, it doesn't tell you your speed, and it definitely doesn't tell you your destination. It just tells you if the engine under the hood is running too hot or too cold. It's measuring the internal energy of the move. And this distinction is absolutely critical in the crypto market, where prices can, swing by double digits in just a matter of minutes. You really need to know if the momentum driving that sudden price spike is genuinely powerful, or if the engine is just overheating and about to stall out. To make this temperature gauge easy to read, the RSI operates strictly on a mathematical scale from 0 to 100. It typically looks back over a default period of 14 candles, so that could be 14 days, 14 hours, or 14 minutes, depending entirely on the chart you're looking at. And this bound scale is a really vital feature. In the wild, highly volatile world of crypto, you might be trading a meme coin valued at a fraction of a penny one day, and then Bitcoin at $70,000 the next. Because the RSI is an oscillator firmly bound between 0 and 100, it actually standardizes momentum. It gives you a fixed, totally reliable baseline to measure market extremes across the board, completely independent of the asset's actual dollar value. Moving on to Section 2, overbought versus oversold. So there are two extreme zones on this 0 to 100 scale that you absolutely need to memorize: overbought and oversold. When the RSI pushes toward the top of the scale, which is typically when it crosses above that 70 mark, the market is considered overbought. The engine is running way too hot. Psychologically speaking, this is usually when retail buyers are getting super euphoric. They see giant green candles, crypto Twitter is absolutely exploding with hype, and FOMO just totally takes over. The RSI crossing 70 is essentially flashing a warning sign that the asset has been pushed up way too fast by this euphoria, and an impending pullback is highly likely. On the flip side, when the RSI drops down toward the bottom of the scale, crossing below 30, the market is oversold. Panic sellers have capitulated, liquidations have cascaded, and real despair has set in. This extreme cold reading potentially signals that the crypto is heavily discounted and is due for a bounce. Understanding the raw psychology behind these two zones is really your foundation for reading momentum. All right, Section 3, spotting market divergence. This brings us to a really critical question. What actually happens when the price and the RSI actively disagree with each other? Think about it. What does it mean for your portfolio when a coin is making massive new highs on the price chart, but your RSI dashboard is actually trending down, making lower highs? The price action is telling you one wildly bullish story, but your underlying momentum gauge is telling you the exact opposite. Well, that precise disagreement is what we call divergence. And it is literally your early warning system that the current trend is running out of gas and is probably about to reverse. Imagine throwing a heavy ball straight up into the air. Right before it reaches its absolute peak and begins to fall, it is technically still moving upward, making a new high, right? But its upward momentum is rapidly decaying to zero. That's divergence in a nutshell. We saw this famously play out with Bitcoin back in late 2021. The price pushed to a massive new all-time high of $69,000 in November, but the RSI peaked significantly lower than it had months prior during the April run-up. The buyers were utterly exhausted, even though the price chart looked totally euphoric. Spotting this bearish divergence allows you to prepare for a reversal, maybe take some profits, or just manage your risk before the rest of the market gets caught completely off guard. Section 4. The limitations of RSI. Now, before we go any further, we definitely need a stark reality check regarding the limitations of the RSI. Look, it's a tool, not a crystal ball. First of all, it can absolutely produce false signals. A market can look heavily oversold and simply just keep dropping for another month, completely crushing anyone who bought the dip blindly. Second, it's a lagging indicator during sudden, violent market moves. Consider a massive news event like a surprise spot ETF approval or maybe a sudden exchange hack. The price might gap up or down thousands of dollars in a single hour. The RSI will instantly shoot to 90 or drop to 10. If you try to short an ETF approval just because the RSI says it's overbought, the sheer force of institutional volume will more than likely liquidate your position. And finally, RSI just cannot replace comprehensive analysis. It's got to be combined with volume profiles, key support and resistance levels, and fundamental catalysts. Which leads us to Section 5, RSI in trend context. You absolutely cannot use the RSI in a vacuum. You have to factor in the overall macro trend context to validate whether an overbought or oversold signal is actually reliable. Context is literally everything here. In a raging euphoric crypto bull market, an asset can become overbought on the RSI and just stay overbought for weeks on end as the price goes totally parabolic. In strong uptrends, hitting 70 is very often a sign of immense strength, not an immediate short signal. I mean, if you sold your bags just because the RSI hit 75, you'd miss out on massive cycle-defining gains. Conversely, in a brutal crypto winter, an asset can become oversold and just keep bleeding out. You have to identify the macro trend first, like are we in a primary bull or bear phase, and then use the RSI to find favorable entries within that established trend, rather than constantly trying to fight it. Let's wrap up with Section 6, Practical Step, Backtesting Signals. Okay, so to build real confidence with this, you need to historically backtest these signals yourself. It's super simple. Step 1, open up a historical chart of your favorite crypto asset. Step 2, scroll back in time and identify past instances of RSI divergence or extreme overbought and oversold conditions. And step 3, just move the chart forward slowly, candle by candle, to see if the price actually reacted the way the theory suggested it would. Doing this manually really trains your eye, but more importantly, it builds your psychological resilience. Trading involves immense emotional pressure, and when real money is on the line, panic can easily take over. Backtesting basically proves to your own brain exactly where the indicator succeeds and, crucially, where it fails, before you risk a single dime of real capital. It builds that muscle memory you need to execute a plan objectively. So you now know the signals, you know the momentum mechanics, and you know the divergence traps. But does your own historical data prove they actually work for the specific coins you trade? Look, information is just potential. Application is where the real power is. So the ultimate question I'll leave you with is this. Are you going to blindly trust the next RSI alert you see on social media? Or are you going to pull up your charts right now and prove its history first? Thanks for joining me on this explainer, and happy back.